Hello everyone. Now we are going to start the second part of the book, the accounting part. We will start with a little introduction, then we have 4 sections or 4 chapters of accounting. Now let's start with the corporation. What is a corporation and what are the characteristics of the corporation? A corporation is a legal entity that is separate and distinct from its owners. This means that the corporations enjoy the rights and the responsibilities of any individual. They enter contracts, they loan and borrow the money, they hire employees, and they pay taxes. The owners of the corporations are the stockholders. They are called stockholders since they have the stocks of the corporations, and they are also known as shareholders. Corporations could be public corporation or a private corporation. A public corporation or a publicly held corporation means that the corporation trades its stocks in the public markets, while the privately held corporation or private corporation is owned by a small number of stockholders and does not trade its stocks in the public market. The stockholders of the corporations have limited liability, so the creditors cannot go beyond the assets of the corporation, and the maximum loss a stockholder may suffer is his amount invested to buy his stocks. Finally, the stockholders control the company by electing the board of directors, which is direct the corporation's affairs and which select the CEO, the Chief Executive Officer of the company. Now let's explain the capital stock. The capital stock is the capital of the corporation, and it is formed from 2 classes of stocks, the common stock and the preferred stock. I'd like to note that the stockholders that have common stock are called common stockholders, and the stockholders that have preferred stocks, they are called preferred stockholders. So what is the difference between common stock and preferred stock? When the corporation has only one class of stock, this is the common stock. But the corporations may issue another type of stocks, which is preferred stock. Preferred stock usually issued by the corporations to attract more investors. Preferred stockholders enjoy preferences and benefits over common stockholders, such as dividends and liquidation preferences. For example, in the case of liquidation, the preferred stockholders and the creditors receive their rights, and then the common stockholders receive their right. So the preferred stockholders receive the rights before the common stockholders. I'd like to note that only common stockholders have the right to vote in the election of board of directors. As we explained earlier, the stockholders elect the board of directors, but only common stockholders have this right. Now, what are the dividends and what are the retained earnings? Usually corporations make profit, and the corporations usually distribute a part of this profit to the stockholders. These are the dividends. So the dividends are the portion of the profit distributed to stockholders. The undistributed part of the profit is called retained earnings. Companies or corporations usually retain a part of their profit for future use, maybe for development, for expansions, whatever. So the undistributed part of the profit is called retained earnings. When the corporations issue the stocks, they should take into consideration the following. Authorized stocks. Authorized stocks is the number or the maximum number of stocks that can issue in the market. The company can issue in the market or can sell in the market. So it is the maximum number of shares. Issued stocks are the number of stocks that are actually sold in the market. So the difference between authorized and issued stocks is authorized stocks, the maximum number to be issued in the market, while issued stocks are the total number of stocks that are actually sold on the market. Treasury stocks are the number of stocks that the corporation repurchases them from its shareholders. Outstanding stocks are the stocks available today in the market. It is the difference between the number of shares issued or sold and the number of treasury shares. So it is shares issued minus treasury shares. Now let's explain the difference between market value, par value, no par, and stated value of the stock. Now let's explain the difference between market value, par value, no par, and stated value of a stock. Let's start with the par value. Par value or nominal value or book value is the original price of the stock. It is the original price, means that the sales price of the stock. The sales price stated by the corporation. This is the par value. Sometimes the charter or the contract of the corporation did not specify a par value, so the stock is considered to have a no par value. However, the board of directors can later assign the stock's book value, now known as the stated value. So we use the term stated value when the charter did not specify the par value, and we call it stated value. So the board of directors assign the stated value. So what is the market value? The market value is the value of the stock in the market today. This is the market value of the stock. Now let's start the section A in accounting part, the accounts classification. We start with the basic equation of accounting. The basic equation of accounting is assets equal liabilities plus stockholders' equity. Assets are the resources of the business. Resources of the business such as cars, buildings, cash. The rights or the claims to the assets are divided into types: the liabilities and the stockholders' equity. The liabilities are the right of creditors and the stockholders' equity are the right of owners. Now we are going to explain each component of the accounting equation. We start with assets. As we explained, assets are the resources of the company and they are divided in 4 categories: current assets, long-term investments, fixed assets, and intangible assets. In accounting, when we say current, the term current is for a period less than 1 year. So when we say current assets, so they are cash amount, or they are accounts or assets expected to be converted to cash during 1 year. Now we have 7 types of current assets. Please do study them in their order from 1 to 7. We start with cash. When we say cash, they are our money in our safe box, or they are our cash money in our bank account. Then we have short-term investment. Short-term investment includes securities such as bonds and stocks, and they are held for trading. They are held for resale in the near future to make some profit. The third account in current assets is accounts receivable. Accounts receivable are the accounts of customers, credit customers, or customers on account. So when we make a service for a credit customer, or when we sell a merchandise for a credit customer, we use the account receivable. So they are expected to be collected during the current year. The notes receivable is, as well as account receivable, they are the credit customer's account. But in the case of note receivable, we have a written promise from the customer to prove their obligations. Actually, there is another difference between the accounts receivable and notes receivable. Accounts receivable do not bear interest, but notes receivable do bear interest. Now, inventory. Inventory are goods purchased by the company, then stored in the warehouse, and they are intended to be sold to the customers. Supplies. Supplies are small assets or small tools purchased to be used during the accounting period. Examples on supplies are papers, ink, stationery, and so on. Prepaid expenses are expenses paid in advance. So expenses such as rent, such as salaries, such as interest. So we are going later on explain what are the expenses. Now prepaid expenses are expenses, but they are paid in advance, such as we have a rent paid for 1 year from now. So this is a prepaid rent. For example, insurance policies. Insurance policies are usually made for 1 year, for 2 years, for 3 years, and so on. So they are not expense for the current period. Since they are paid in advance for many years or for many periods, they are considered as prepaid expenses. Now we start with the second category of asset, the long-term investments. Long-term investments is investment for more than 1 year. It is for many years. It can be investment in securities, such as investment in bonds and stocks. In this case, we purchase stocks and bonds and we held them for many years. The second one is the investment in fixed assets. For example, when we buy a land, a building for many years and not intended to be sold in the near future. These are the long-term investment. The third category of assets is the fixed assets. They are also known as property, plant, and equipment, and they are abbreviated as PPE. Fixed assets are purchased to be used in daily activities and daily operations. Usually, we held fixed assets for long-term periods. So the purpose of fixed assets is to be used in the operations and not to be sold. We have 4 types of fixed assets. The first one is the land. For example, we buy a land to build a factory or a warehouse. In this case, land is considered as fixed asset. Buildings. The buildings include our offices and our factories. Automotives such as trucks and cars and whatever. Equipment, examples on equipment, machines and furnitures. The last category in assets is the intangible assets. Intangible assets do not have physical substance. They are somehow moral. We have 4 types of intangible assets. Goodwill represents the value of the company in the market. This includes the name of the company, the number of customers, and so on. So goodwill represents the reputation of the company in the market. The second intangible asset is the patent. They are usually a declaration issued by the government to protect our inventions and innovations. When we have a patent for a product, we stop others from making and selling this product. The third intangible asset is copyright. Copyright is the exclusive right given to the owner to replicate and sell an artistic or published work. Usually copyrights are given for books, for softwares, and so on. The last intangible asset is the trademark. Trademark is also known as trade name. It is the brand name. So it is the name of our product. For example, Nike, Adidas, and etc. Now let's move to the second component of the basic equation accounting, which is liabilities. Liabilities are obligations or debt to be paid by the company. They are the rights of the creditors. Liabilities divided in two categories, current liabilities and long-term liabilities. The current liabilities are the obligations and debt to be paid by the company to the creditors within 1 year, but long-term liabilities are obligations and debt to be paid by the company in a period more than 1 year. Let's start with the current liabilities. As we previously mentioned, current liabilities are obligations to be paid within 1 year. The first two types of current liabilities are notes payable and accounts payable. Accounts payable, we use this account when we buy an asset on account. For example, when we buy merchandise on account. So accounts payable is the account of the suppliers of the company, the suppliers on account. We use notes payable as well as accounts payable. It is the account of suppliers. We use this account when we buy an asset on account. But the difference that in the case of notes payable, we give the supplier a written promise. And the notes payable bear interest, but accounts payable do not bear interest. Accrued expenses or accruals. They are expenses due but unpaid. For example, salaries due but remain unpaid. In this situation, the salaries will be transformed to liabilities, current liability, and will be called as salaries payable instead of salaries expenses. Another example is the case of rent. If the rent is due and remains unpaid, it will be a current liability, and we will use the rent payable instead of rent expenses. The last account in current liabilities is the unearned revenue. Unearned revenue is also called unearned service revenue, and actually this account is used only by services companies. But when do we use this account? We use this account when money received from customers but services not rendered yet. We give an example in airline companies. Airline companies receive the traveling tickets price from customers, but they provide the traveling services in the near future. So when the airline companies receive cash from customers, they consider this cash as unearned service revenue. The second type of liabilities is the long-term liabilities. They are obligations expected to be paid in more than 1 year, and they include notes payable. Notes payable is the same notes payable previously explained in the current liability section, but the difference that here the due date of the long-term notes payable is for a period more than 1 year. The second one is the long-term loans. Long-term loans are loans taken from the banks for a period more than 1 year. For example, loan for 5 years, for 10 years, and whatever. The third type of long-term liabilities is the bonds payable. Corporations and governments may issue bonds payable to finance their activities. So they issue bonds payable when they need cash money. Bonds payable are usually issued for long-term periods, and they have a due date. They should be paid on this due date, and they bear interest as well. Example on bonds payable. The Eurobonds. The Eurobonds issued by the Lebanese government is a kind of bonds payable. Lebanese government did issue these bonds in the past because they needed cash money. And today is the due date. The due date to pay the amount borrowed as bonds payable and the interest due as well. The last type of long-term liabilities is the mortgage payable. It is similar to long-term loan, but in this case, the mortgage payable is secured by a property such as a building or a land or whatever. The last component of the basic accounting equation is the stockholders' equity. Stockholders' equity is the right of the owners. This is the capital of the corporation, and it is formed from three basic components. The first component is the paid-in capital or contributed capital. This is the capital stocks. Stockholders acquire stocks by paying cash or by providing other assets. The second component of the stockholders' equity is the retained earnings. The retained earnings is the portion of income or the portion of profit that is retained in the corporation. They are not distributed to the stockholders. The last component is the treasury stock. Treasury stock are reacquired stocks. Reacquired stocks from the market and from the stockholders. They are deduction from the stockholders' equity. Finally, stockholders' equity can be calculated in the following equation. Stockholders' equity equal paid-in capital plus retained earnings minus treasury stocks. Now we have finished the basic equation of accounting. Let's define revenues and expenses. We start with revenues. Revenues are the fees earned from providing services or from selling merchandise to customers. Revenues are recorded at the time of the transaction, even if the transaction is on credit. So when we provide service or sell merchandise, cash or on account, we have to record revenues. Some examples on revenues or accounts used for revenues. When we sell merchandise, we use the account sales or sales revenue. When we provide services, we use the account services revenues. When we provide the rent services, we use the account rent revenue, and etc. Finally, let's define expenses. Expenses are the money spent or the costs incurred by a business in their effort to generate revenues. So they represent the cost of doing business. There are many examples on expenses such as salaries paid to employees, it is salaries expenses, the rent expenses, insurance expenses, interest, utilities, advertising expenses, and many other examples. Now let's solve exercise 1, page 7 on your book. Mr. Sam decides to open a new consulting company. During the month of May, the following transactions occurred. So we have these transactions. The required is to prepare a schedule of transactions showing the effect of each of the above transaction on the mentioned accounts and then totaling each account. The top of the schedule should be as shown in the figure in the slide. So I have cash, land, equipment, accounts receivable, accounts payable, capital, long-term loans, revenues, and expenses. Let's say that these accounts are given in the top of the schedule. Now, let's start with the transactions. On May 2nd, Mr. Sam started with 80,000 in the bank account. Started with 80 mean that the capital is 80. So we have in the schedule capital 80,000 and we have cash 80 because when we put in our company $80,000, so this is a cash amount. Actually, each transaction should have at least 2 accounts to be affected. So in the first transaction, we have cash and we have capital. May 6. Purchased equipment worth 25,000 on credit. Purchased equipment for 25, this means that the equipment increases by 25,000. That's why equipment is positive 25. We purchase this equipment on account. We remember that when we buy an asset on account, we use the accounts payable. That's why the second account affected here is accounts payable. So in this date, we have equipment at 25 and accounts payable 25. May 10. Performed services on a credit totaling 10,000. We perform a service. When we perform a service, we know that the services are revenues and we have to record this revenues whether the account is cash, whether the transaction is cash or on account. Here the transaction is on account. So we have to record revenues as 10,000 and we do know that when we perform a service for a credit customer, we use the accounts receivable. So the second account increases here is the accounts receivable. 14. Take long-term loan for a land 70. So here we buy a land for 70 and we take a long-term loan to buy this land. So when we buy a land, the land increases 70, and when we take the loan, our long-term loans increases by 70. So the two accounts affected here are the land increased by 70 and the long-term loans increased by 70 as well. Let's go to 19, date May 19. Received a check of $5,000 from a client in payment on a credit. Here we have a collection from a customer. A customer make a payment for us. So we received actually, another term we can say, we receive $5,000 from a credit customer. We can say it this way. When we receive from a customer cash, the cash would increase, what would increase 5,000. So we have cash positive here, 5,000. And when a customer pays off his account, so his account will be decreased because we make collection. The customer, when a customer makes a payment, his account will be decreased. So on this date, the account receivable, which is the account of the credit customers, would be decreased by 5,000. So here the two accounts are cash positive 5,000, but accounts receivable minus 5,000. We can put minus 5,000 or we can put 5,000 between the brackets. The same effect actually. So when we find an amount between the brackets, this means that the amount is negative. 24. Paid 11,000 due to suppliers. Now we have to pay 11,000 to our suppliers. Which account reflects our supplier? Our supplier's account is the accounts payable. We paid 11,000 to our suppliers, so our accounts payable would be decreased because we pay this account. We pay 11, so accounts payable decreased 11, and we pay 11, so the cash would be decreased 11 as well. 30. Paid 4,000 rand for the current month. Now we are paying a rent. A rent, as we know, is an expense. So expenses increased 4,000 and the cash account decreased 4,000 because we pay 4,000, so the cash will be decreased. At the end, we calculate the total of each column. Now let's solve exercise 2, page 8 on your book. This exercise is similar to the first exercise. We have to fill the schedule of transaction to show the effect of each transactions, similar as exercise 1. So we have transactions on the month of July, during the month of July. Let's start with the schedule, the top of the schedule, the first row. Let's say the accounts are given, which are date, cash, building, equipment, accounts receivable, accounts payable, capital, revenues, and expenses. Let's say they are given. Now we start the transactions. On July 1st, Ahmad started with 500,000 in the bank account. So when we start our business, we have the capital, which is 500,000, and we put this money in our bank. So we have cash as well, 500, because we know when we have money in our save box or in a bank account, this is considered as cash. July 5, purchased building worth 200,000 cash. We purchase a building, so the building would increase by the amount of the building, which is 200,000. We pay cash the amount or the cost of the building. Since we pay cash, the cash would decrease by 200,000. July 10, purchase equipment for 50,000 on account. Now we purchased an equipment, so equipment would increase by 50, the amount or the cost of the equipment. But here we did not pay cash. The transaction is on account. We purchase an asset, which is equipment, on account. And when we buy an asset on account, we use the account of our suppliers on account, which is accounts payable. So here we purchase equipment on account, so we use equipment 50, and the accounts payable would increase as well by 50. Date July 15, performed services for 30,000 on account. Now we perform service to a credit customer since it is on account, the transaction is on account. The account of our customers, our credit customers, now we know is the accounts receivable. So the customer's account, which is account receivable, would increase by 30. And when we perform a service, we know that services are recorded as revenues. So we have revenues 30 as well. Now July 18, received a payment of 5,000 from a client. Now we have a collection from a client. When we receive a collection from a client, we have to receive this collection in cash account. So the cash account would increase by 5, and we have to reduce the account of the customer since he pays his account. So 5,000 decreases in account receivable. We can realize that 5,000 in account receivable is between the brackets. So this is minus 5,000. And the date 25 paid 20,000 from the amount in purchasing of equipment. We purchased the equipment in the date 10, July 10. In July 10 we have equipment and we have 50. But when we pay now 20 from the amount, this indicates that the accounts payable and not the equipment, because the equipment 50, this is the cost of the equipment, and it is recorded only once. Okay, so the 50 of equipment is only when we buy the equipment. We cannot reduce this amount. We cannot reduce this amount. Our obligations is in the accounts payable. So when we pay the amount due, we have to reduce the accounts payable and not the equipment. So in 25 we pay 20 from the amount of the equipment, so we can realize that accounts payable is minus 20 because we pay off the supplier, so we reduce his amount, and the cash account as well minus 20, because when we pay 20 the cash would decrease by 20. The last transaction is on July 30, paid 4,000 salaries for the current month. Salaries, as we know, is an expense. So salaries expenses would be increased expenses by 4,000. And since we pay expenses, so the cash account will decrease by 4,000. And finally, we calculate the total of each column.